I agree. I agree. Why don't we go to our final question, last question? It is a local problem, I believe, local question. As I sent you some articles by email, in Korea, following the scandal of last year's scandal, which is the derivative-linked fund, the DLF, we have a certain scandal of suspended redemption of those investors of DLF last year, sold by some major banks and security companies. And this year, as you may know, the company name Lime Asset Management, Optimus Asset Management. One is hedge fund, the other is private equity fund. What they said, no one knows who they are exactly, but their redemption is suspended by the government, and the FSS Financial Supervisory Service, which is financial regulatory authority in Korea, they are starting the inspection, on-site inspection of those companies, private equity fund and hedge fund in Korea, which means the public perception of the private fund investment is getting very negative. It's seriously hurting their images in Korean market, and that affect individual investors and institutional investors, LPs, when they allocate their money into the public fund and the private fund. Not only the domestic private fund, but also the offshore private fund is affecting in Korean market. And I would like to ask you guys, Bill and Brant, Michael, what is your view about this kind of the situation? I'm sure you guys have a similar cases in US market, not only the LTCM, Madoff, and so on, Amaron's capital management. Some are failed, some failed due to their misconduct of operations and management. Some failed because of the fraud operations. And how did you overcome this kind of the situation and public perception image of the private fund? As a Korean investors, there is a buy side and sell side and regulators and academics. We would like to listen and learn of your experience in the States.
So maybe I'll just address this for a minute or two. And thank you for the question, because I think it's, I think it's particularly with some of the larger investors in your market on the phone today. I guess I'll just share our experience, which is, a lot of our clientele are some of the largest US states. So this is all publicly disclosed, for example, the state of Virginia, state of Tennessee, state of New Mexico, and so forth. And, a couple things I'll share how they interact with us as a way of thinking about risk mitigation. The first is they conduct exhaustive due diligence on-site and off-site from an operational perspective, from an accounting.
Michael, who are they? They means investors?
Our investors, and oftentimes they're consultants and advisors, but more often than not, it is those investors directly as well are huge participants. That's so one aspect is, I think the due diligence process has become very robust and benefits firms that have invested substantially in infrastructure. And I think, a good due diligence process will differentiate between the operations and infrastructure and compliance culture that exists at a lot of firms that have been around for a long time. So that's one thing that investors can do on their side to protect themselves. I mean, you mentioned something like Madoff. I mean, the types of due diligence processes that are conducted on our firm by our clients or people considering investing with us would never have invested with a firm like Madoff, because the process is just too detailed and we provide too much transparency. So that's one aspect. The second aspect, and this has more to do with an approach, most of our largest clientele have elected to invest with us in separately managed accounts where they have line item visibility on their portfolio. We'll tell them every trade we're making if they want it. We'll discuss it with them daily, weekly, or monthly, or whatever their preference is. But the level, the ability to manage in a separately managed account context is required a lot of investment on our part and a lot of policy and procedures. but is hugely protective of the visibility and transparency that our clientele have in what we're doing. And for the biggest clients that, you know, where we can justify the cost and the administration of that, we're happy to consider that rather than commingled funds. And those separately managed accounts, more or less, have the same exact investment strategy and have portfolios that are very, very similar to our commingled funds. They're just separately allocated and separately owned. So that's one way of addressing that type of risk factor that that some set of firms in our business are capable of providing, and others just don't want to, or otherwise aren't able to do it. And so, were I sitting in a large capital allocator seat, I would prefer that methodology typically versus commingling my funds with others and dealing with all the complexity and, you know, less transparency that sometimes that can provide. So
okay, thank you.
Sam, I'm going to also note, by the way, Samantha Levinstein is on the call. Also, up until recently, was with Axia, which is a firm you know well. So she was one of the people who was involved in that due diligence as well. So also
good. Samantha, you can comment on that.
Thank you, Brant, and thank you, Sam. I got to know Beach Point, and I got to know Balyasny as well, so I can also say that they are very institutional. But I got to know Beach Point, and Beach Point got to know me from my seat at Axia because we had many investors with Beach Point. And in terms of operational infrastructure, since Madoff, it really put a firm like Axia on the map, because you do really have to do the extra due diligence. You have to make sure there's a separate administrator and, you know, make sure it's very institutional in quality. And one of the reasons that I joined Beach Point is because I appreciated that they do fund of ones and separately managed accounts, because I think the caliber and size of investor, such as those on the phone, it really does make a difference, as Michael said.
I see. So both Michael and Samantha says I think it's from the institutional investors' point of view, it makes sense. But what if there is a high net worth individual investors? They have a limited ability of the due diligence, and they may not ask the high level of transparencies, and also it's hard to invest as just SMA or fund of one kind of platform. They just do invest in the commingled fund format, and they have difficulties to control all of these kind of process. Do you have any individual investors and Beach Point Capital?
We do. They tend to be relationships rather than, we don't really seek to attract retail capital per se. But yeah, we do have them. And how would I encourage those investors to get comfortable? One is, you know, multi-decade track records help. The second is being able to reasonably understand the portfolio context and the types of investments that a manager is making. And second, you know, you can, pardon the expression, but ride the coattails of large institutions who have already done diligence. So if I were a smaller investor, I would want to know that my manager had clients like various states and large other municipalities and pension funds who are doing that diligence anyway. And so aligning yourself with largely institutional managers to the extent that you can find the investment capacity, I think is one way of addressing that risk.
I see. Bill, you have?
Sure, thank you. I would just say, like Beachway, we are not actively courting retail investors. We do encourage our employees to invest, and I think that's a metric that you know, people should look at as part of their due diligence on a fund. You know, are the people who working at the fund investing in the fund? So I think that's an important metric. I agree with the comments that Michael said. You know, as a result of the Madoff situation in the U.S., the hedge fund community, or the alternative investment community, not just hedge funds, the alternative investment community had to increase its institutionalization, and investors began to look to see, you know, not only do you have good portfolio managers, but do you have a good risk officer? Do you have good business managers, et cetera, et cetera? So institutionalization increased and transparency greatly increased. And so the volume and the type of information that we present to our investors is certainly increased over the last 10 years. You know, for the situation that you referenced, Dr. Chan, with Lime and Optimus, I did read those articles. Thank you. You know, both of those two funds looked to me like they were actively courting retail investors. And it's interesting, if you go back to the Madoff situation in the US in 2008, he too was predominantly courting retail investors. Now, they were very high net worth individuals, but still, they were retail investors. They may not have been doing enough due diligence. They probably weren't. They may not have even known how to do the right due diligence. You know, it was an era back then of falling rates, as is the current era of low rates. And when rates are coming down, I think the retail investor sometimes reaches for products that offer a higher than expected return. And you know, if something is too good to be true, it may not be true. And you know, I think part of the answer, you know, for the Korean alternative investment industry, you know, I think institutionalization, transparency, and perhaps the potential for more regulatory oversight.
I see. So the qualification of the investors obviously would matter. Who can be private fund investors? And in the States case, I believe they should be the accredited investor, and the accredited investor is supposed to be a very high level of sophistication in terms of the risk management and so on. So in order to estimate their level of sophistication, you guys are looking at the net wealth or income. Is that true?
Well, to meet the accredited investor criteria in the U.S., you do have to have a certain minimum income and or a certain minimum liquid net worth requirement. But again, we're not out actively recruiting retail investors. So you know, any retail investor we have, similar to what Michael described, it's most likely a relationship to the firm, or it is an employee.
Sam, I think it is the case almost invariably with the big public pension plans that they have investment consultants like Axia working with them to take care in part of this issue. It's just become standard practice, right? Institutional investors, retail investors, different things.
Right. And also one point I would like to ask is what about the regulatory issue? Do we have any loopholes on the regulations? And what is the optimal level of monitoring the private fund management or something like that? What do we have certain idea about that? What kind of the level of information we need to ask the private fund managers? Position level, their strategy, the kind of the transparency issue.
I'll speak for our clientele, who I think do the best job, and say they, first of all, to Brandt's comment, they tend to have sophisticated advisors. I agree with that. That's useful to their process. Second, I think they tend to have periodic updates, and they want to walk through line item by line item results, and which were the biggest gains and which were the biggest losses and why, and tend to have a good feel. And mostly what I think that they should be looking for is, you know, all of us use the term style creep, which is we get hired for a specific job by our clientele. And if I were those clients, the biggest red flag to me would be a portfolio that ceases to really pursue the reason that Beach Point was hired in the first place. And so style creep, I think, is sort of the biggest red flag and risk factor. And quite honestly, it's something we're very conscientious of because, you know, in a competitive world, you always see things that might be a little bit outside of your comfort zone, but appear on their face to be attractive. And you have this tendency to want to, you know, sort of dip a toe in. And we have I'd like to think, a fair amount of discipline about avoiding that toe dipping and really keep sort of super concise on what we're paying attention to and the job we're doing versus, you know, what our clients have hired us for. So those are the types of risk factors that I see are red flags that our clientele who are really good at their job would notice. And I would like to think with us, they don't notice that because we don't pursue that. So.
Okay. Bill, any comments?
You know, just very quickly, our investors, similar to Michael's, you know, are almost exclusively very sophisticated institutions, and they also have sophisticated advisors, probably many of the same advisors, and they do a lot of good, thorough due diligence. Excuse me. We encourage, you know, our investors to get to know as many of the investment professionals at Balyasny as they would wish to. And one advantage of being a global firm is that, you know, if an investor is in London, we have an office, and that investor is welcome to spend a day in that office. Likewise, if they're in New York or Chicago or Hong Kong, et cetera. We've also, in the past, we've had a program where we've had some of our investors send a representative on site to one of our offices for a period of 2 to 3 weeks, where they can essentially be embedded upon either an investment team or a part of the firm's business operations team. So I think that's an excellent way for an investor to get to know one of his potential funds, is to spend as much time as you can at that fund on site.
Sam,
Yes.
just the experience that we've had, we deal with a lot of all the major consultants. And one thing I used to find at the peak of the hedge fund, I guess, I don't know how many hedge funds there are at now, but let's say there were more than 10,000, 12,000. There were about 500. Sam can probably give this number better than I can, but I think there was a consensus that there were around 500 on the list that were sort of institutional quality. There were thousands upon thousands of others that I'm sure retail investors could invest with, but there were the 500, everybody knew who those 500 were, plus or minus. I'm sure Sam knew them all by heart.
I see. Okay. Now, any comments from the local side? Mr. Saw and Mr. Jang Dong-han from POBA, Mr. Kim?
Yes,
Do we have, in Korean market, do we have any impact from this kind of a private fund scandal these days? When you discuss the allocation to those private funds, well, how's your view about this situation, in local situation? Can you give us brief comments on that? Mr. Jang Dong-han.
Yeah, I think, that kind of, scandal have affected quite substantially in Korean alternative investment industry. But I think as an institutional level, I think it's not much impacted on our investment that much. However, I think, we have realized that, how important for us to select, external GPs. That's what, I have really focused on during the past 4 to 5 years. So, that's the way we should be more focused on. So just because, we make 100% in indirect investment. Yeah.
Mr. Saw?
Yes, as a gatekeeper, we have some retail hedge fund businesses. So in my point, the problem is the companies like us should do due diligence more precisely, because we have many chances, like we do investing this kind of fund before, but as we do very precise due diligence by ourselves, so we do not invest this kind of fund before. So I think the most important thing is the asset management company like us do the due diligence more precisely.
Okay, so I think
I have a very basic questions about the hedge fund, because as a gatekeeper, we have some local institutional investors as a clients. So after COVID, they asking about like this. During the COVID crisis, on correlation with market increasing very rapidly, and the performance dropped down very much. So after that, they think hedge fund performance is not much difference with just better product. Also, they are thinking about investing more to more private fund, like private equities, or private debt, or some real asset directly. So I wonder the situation in USA and how the hedge fund industry respond this kind of situation.
Interesting question. Who can answer that? First.
So may I repeat?
Michael?
I think I understand the question, but the question is, how do we reflect upon the correlation of hedge funds to the markets overall, and if highly correlated, why is that an attractive alternative? Is that?
Yeah. Also, what's the institutional investors respond this kind the market fluctuation and hedge fund performance fluctuation, and the increasing of the beta, the hedge fund beta with the market?
Yeah. So I'll give you my answer, which is, when I think of the clientele we have as investing with us, generally speaking, over a reasonably long time horizon. And I think, track records dictate how much correlation you have to the broader markets. And it's tough to look at correlation on a monthly or quarterly basis when, at least in our market, we're investing in assets that aren't all that terribly liquid. So like I could show you a private fund that would show, no real correlation to the underlying markets, but that's because you're not marking those assets on a daily basis, and they're not really trading on a daily basis. Equally, I could show you, a more liquid fund that we manage that appears to have really high correlation in a month or a quarter, but has not demonstrated that over 5 years. So I just think, stylistically, you just have to look at, reasonably long time horizons to get a feel for how much pure market risk you're taking.
But Michael, do you agree the Mr. So's point of only short-term period like this year? If you look at the window of this year, 2020,
yeah,
the traditional benefit of a hedge fund is decreased. For example, the volatility of the returns, the correlation with the market, the beta, low beta with the market. That's what the traditional hedge fund benefit, many people believe. That's why they allocate the hedge fund. But Mr. So point out that if you look at this year, this kind of time, short-term period, we still have such a benefit as a portion of the total portfolio.
I think yes. I think some funds demonstrate high correlation, when sort of assets overall experience high correlation, but would not demonstrate that in the next quarter. So if you're looking as a hedge fund at, hey, when the market's down, I just want to be flat, that's one reason to make an investment, but there will be very few quarters in a year or 3 years or 5 years where that really matters over that extended period of time. And so if you're, I guess I'd say this is maybe a bit cynical, but if you're looking to be flat when the market's down in all circumstances, maybe just sit on cash. I mean, I think it's hard to not take any market risk in any context if you want to stay invested. I do think you can find strategies, and there are, long short strategies and event-driven strategies that demonstrate less volatility over a cycle. A month, or a quarter is a very short period of time for any but the most liquid asset classes. So I guess that's how I think about that question. Hopefully that was...
Okay. Thank you.
I would just add to that very quickly.
Uh-huh.
I would just add to that very quickly that broadly speaking, I think if you look at U.S. hedge funds, the answer would be that they have not delivered on their promise of delivering uncorrelated returns. But again, that's looking at the sum total of however many hedge funds there are, 5,000 or 9,000. Our investors and the various people who are considering investing in Balyasny, they look at us individually, and we have not been correlated to the market. March of this year, we were up 3%. The market was down quite a bit in the month of March. So I agree, 1 month or 1 quarter is a very short period of time. But if you look at our fund and other funds, it's not just us, there are a group of funds that have shown that they're not correlated and that their strategy offers an attractive return stream. So what we're seeing within the U.S., I believe, is a mix shift, whereas investors are coming out of sort of the traditional single manager style fund and are shifting into newer strategies or different strategies like multi-strategy and other niche type strategies that have proven the return stream does offer the characteristics they wish for.
Good. Thank you. Thank you. I think we are out of time. Before I close, can I introduce one of our audience? His name is Tai Lin from Proterra Asia, Proterra Capital Management in Asia. Hi, Tai Lin. Can you hear me? Mr. Lin? Hello?
Yes, hello. I can
Hi,
hear
how are you? Yeah. Could you just briefly introduce yourself?
Sure. Yes. Let me try to make my video here. Yes, hello everybody.
Yes.
My name is Tai, and I was not able to join the first part of this discussion. I did listen to some of it, so thank you for the contributions to everybody. I run a company called Proterra Asia, which is the Asian arm of a US PE fund manager called Proterra Investment Partners. And Proterra Investment Partners invests into food-focused strategies globally. We are a team that spun out of a US company called Cargill around 4 or 5 years ago. And before that, we were within Cargill managing money for outside investors and some of Cargill's balance sheet money as well. So Proterra globally manages around $3 billion. We have different teams and funds, PE funds for different regions in the world. And the Proterra Asia portion of that is roughly $1.3, $1.4 billion. Over the last 10 years, we've invested in 20 to 30 different investments. Nearly half of them are majority investments. Mostly the big markets with high growth. So that's China, Southeast Asia, some India. And we have now been ranked as the #1 private equity firm focused solely on food and agribusiness strategies. So I have been working with the colleagues here from BCC and GAIC since earlier this year, and have the privilege to listen into most of those webinars. So thank you for letting me make a short introduction, and also thank you for letting me learn from everybody on this call.
Thank you, Tai Lin. I hope we have another chance in the future to discuss your business here. Thank you. Thank you. Do we have any other comments or questions before we close this session? I appreciate to all of you your time and effort here. Brant?
No, I think this was terrific. I appreciate it very much. We look forward to continuing our work with you and the South Korean investor community. Thank you for the honor.
Thank you. Michael, thank you. Bill, thank you. Mr. Jang Dong-hwan.
You're very welcome. Thank you.
Thank you, Mr. Kim Jung-gun. Thank you, Mr. Seo Jung-do. Thank you. Thank you, Samantha.
Thank you, everyone.
All right. I hope to see you soon again.
Bye.
Bye-bye. Good night.
Bye.
Bye.
Good night.
Bye bye.